We need to be super cautious in the current financial climate. Numerous major banks such as JP Morgan are warning of earnings downgrades, indicating a challenging financial situation. We are in the midst of a banking crisis, and real estate is going to experience a significant downturn. Buying real estate at lower prices and acquiring assets from struggling companies is a good option now. The commercial real estate downturn is causing banks to face some huge losses, with $2.5 trillion in loans needing refinancing in the next 3 years. Its concerns about real estate are centered on several factors contributing to a difficult situation in the housing market. The current mortgage rates are exceptionally high, which is a stifling activity in the housing market. This is noted by a significant drop of 50% in mortgage applications to buy a house from their peak in 2020. Home prices have surged in recent years, even when adjusted for inflation. They are currently at their highest levels on record, around 90% above the long-term average for inflation-adjusted prices. In addition to high prices and mortgage rates, low inventory levels are leading to fierce competition among homebuyers. This competition further drives up prices. The overall implication is that these factors combined will lead to a significant fall in homebuyer and mortgage demand, creating a precarious situation for this sector. Blackstone is strategically aligning with this trend, raising a $30 billion fund to capitalize on distressed assets. Its plans to invest in this sector's assets globally indicate anticipation of opportunities arising from distressed markets. The shift towards residential conversions and the tightening of credit in commercial real estate will lead to substantial opportunities for investors. Industry associations, including the National Association of Realtors, the Mortgage Bankers Association, and the National Association of Home Builders, have expressed concerns and urged the Federal Reserve to reconsider annual percentage rate hikes to avoid a financial hard landing in this sector. People are withdrawing money from smaller banks, and the Federal Reserve is making efforts to bail out struggling ones. Its emergency actions to bail them out, indicating a serious situation. An epic crash in small banks is predicted, and investors have to reduce risk heading into 2024. People are warned to withdraw money due to a troubling trend of increasing branch closures by major corporations like Provident National Corporation Bank and JP Morgan Chase. The rise in digital banking, cost-saving strategies, and a focus on online transactions are contributing to these closures. The Federal Reserve's aggressive interest rate hikes have also led to struggles for regional banks, causing losses on assets like government bonds. The recent failures of Silicon Valley and Signature Bank have further shaken confidence in the financial system. Concerns about the broader economic situation, credit problems, and several job cuts are prompting individuals to seek alternatives, leading to a decrease in consumer deposits. The CEO of Chase Bank is selling stock for the first time ever, signaling greater problems. The outflow from small banks and the Fed's record-high emergency funding to address the banking crisis indicates the severity of the crisis. JP Morgan's warning suggests that the worst is yet to come for the US economy. The concerns are centered around various factors. There are indications of significant problems in global trade, including challenges in the shipping industry with an oversupply of container ships and a drop in demand for goods. The United States labor market is facing some problems, with evidence of layoffs, decreasing hours worked, and major difficulties for workers as demand for goods slows down. It acknowledges concerns of inflation, the Fed's response to inflation, and the possibility of further rate hikes. This warning implies a complex economic scenario with probable negative impacts on various sectors like employment and consumer spending, leading to a challenging financial environment. The warning revolves around concerns about the current wealth situation, particularly related to rising inflation, high deficits, and escalating national debt. Signs of inflation are evident, including increased costs of raw materials, rising wages, and supply chain disruptions. The substantial national deficit, which has almost doubled the borrowing percentage over the past 3 years, is also a point of worry. The large fiscal and growing deficit levels could lead to serious consequences, such as inflation and high interest rates. A significant portion of the United States budget, which is about 45%, is allocated to social transfer spending, leaving limited room for maneuvering. The concern extends to the actions of the Fed, which is reportedly looking to reduce its bond holdings through a process known as quantitative tightening, which will result in less money circulating in the economy, contributing to higher interest. Its warning about a collapse emphasizes the risks associated with high and escalating national debt, inflation, and the actions of central ones, particularly the Fed. These factors, if not managed carefully, will lead to adverse consequences for the economy, including impacts on the housing market and overall financial stability. Moody's downgraded JP Morgan Chase, Wells Fargo, and Bank of America due to a worsening outlook on their respective debts. Moody's cited concerns about the weaker capacity of the US government to support these systemically important ones. The downgrade reflects worries about their ability to handle risks, especially with JP Morgan's complex capital markets business posing substantial risks to creditors. Despite the downgrade, the stock prices of them are currently in the green for November. Moody is forecasting a mild recession in early 2024, highlighting funding strains on the US banking sector and the tightening of credit conditions. There have been significant interest rises over the last 18 months, with the Federal Reserve raising the percentage from 0% to 5.5% for the Fed funds. It highlights that these increased values have led to elevated costs across various sectors, including credit card, auto loans, and mortgages. There is a disconnect between positive economic indicators and actual profits, and there is a contradiction between what financial experts say and where they invest when it comes to stocks and bonds. Wall Street's current stance on the Federal Reserve is that they believe the Fed has finished its rate hiking campaign. After the fastest interest jumps in history, there is an overwhelming majority on Wall Street indicating that the Fed is done raising rates. This belief can be taken as a positive sign, as it suggests that the worst in terms of rate hikes is behind us and there's relief in the market. While there is a verbal expression in the market that a soft landing is expected, which is going to be more favorable for stocks. Wall Street is parking its money in bonds, which traditionally perform well in economic downturns or deflationary environments. Wall Street's actions are not aligned with their verbal expressions. It suggests that the positioning in bonds will be a sign that Wall Street is preparing for a hard landing rather than the soft landing they are verbally expressing. Despite surface-level economic indicators, there are underlying issues in the housing sector, job markets, and corporate hiring. Let's discuss some important challenges. Executives, including Jamie Dimon of JP Morgan, are cautious about the increases in credit costs as the credit costs are expected to rise, and there is concern about how well consumers and businesses will handle this. Wells Fargo is reported to have taken advantage of higher interest rates to counteract a slowdown in lending. Changes in annual percentage rates can significantly impact banks' profitability and borrowing behavior. The increased capital requirements affect the valuation and mergers and acquisitions activity within the banking sector. Geopolitical risks, including conflicts, adds an additional layer of uncertainty. The significant impact of international events on the banking sector is a concern. The environment for lending is becoming more challenging. We are seeing uncertainties about inflation, and the Fed's actions influence the banking sector. Lack of new innovation and products in the banking space are causing difficulties for growth and value creation. These circumstances collectively shape the outlook for the banking sector, influencing factors like earnings, credit performance. The United States national debt has exceeded $33.8 trillion. One of the significant concerning aspects is the interest payments on this debt will surpass spending in any other category, including defense. By 2033, it's predicted that the government will spend nearly $1.5 trillion annually just to serve it, which is a significant increase from the current $476 billion. There are some other consequences, such as higher taxes for the public as the government grapples with falling tax revenues. A recent Treasury auction happened where investors showed reluctance to buy US bonds, which signals a shift in sentiment. We are falling into a debt trap. United States debt dynamics demand attention. If this pile rises as expected, then interest payments will reach $1.4 trillion by 2033. The government's substantial borrowing, indicated by a $1.8 trillion deficit, contributes to a debt spiral. The more money borrowed, the more interest needs to be paid, leading to a cycle of increasing deficit. Almost 15% of the US budget is spent solely on interest costs. Reports indicate a looming crisis for the United States financial situation, expecting a contraction in lending and increased stress. The widespread defaults are about to happen, driven by individuals facing financial challenges. Institutional investors are taking advantage of distressed situations to acquire commercial property loans. There are both opportunities and problems in the coming years, emphasizing the need for financial preparedness. Concerns about the health of the US banking system, loans, and the government's fiscal strength are widespread. The situation involves individuals, corporations, and real estate investors facing financial struggles due to various factors, including the difficulties in loan renewals and a lack of interest in new US debt. The bond yield, expected inflation rate, and concerns about supply and demand for bonds are mentioned. The evolving global landscape suggests a shift from a single country reserve currency to a multi-currency system. The critical threshold where deficit payments outpace economic growth will lead to higher taxes, bond sell-offs, and slower economic growth. The debt issue has persisted under various presidents, regardless of political affiliation. There is a challenging road ahead, and collective attention is needed to this growing problem. The possibility of a recession in 2024 exists by considering market predictions and insights. A Black Friday sale is trying to navigate the real estate market during such times, anticipating an increase in its price after December. Black Friday sales are the worst in years, indicating a downturn in consumer spending. Be prepared for nearby future economic challenges. By considering the changing landscape, strategic investment is needed. The understanding of market trends, investment strategies, and economic indicators have become the need of the hour. Comment down below on what you think. And if you like this video, please consider liking, subscribing, and sharing the video. Thanks for watching, and we'll see you in the next one.